This is a Farm Doc Daily webinar on University of Illinois Extension's Todd Gleason. Thank you for joining us today. We're going to be talking with Bob Ray today, or Bob Reed today. He is with Navigating. He is going to discuss navigating new depreciation rules to avoid surprises for farm taxpayers as producers finish up their fall field work. They oftentimes will turn to farm taxes and what they need to do to make sure they're paying as little tax as possible. And depreciation rules often can hold some surprises. Thank you, Bob, for being with us. I appreciate you being in studio with Jim Baltz this morning, who's behind the scenes. Thank you to Jim Baltz. Good morning to you. Thanks for being with us, Bob.
Very good. Thank you, Todd. And it's great to be here with Jim. This was advertised as a joint effort with me and my colleague, Brad Swilling. But Brad is doing the most American of things today, Todd. He is a foreman of a jury in Champaign County at the court building. So good for Brad getting that citizen duty done today. So we're going to talk about the depreciation pieces. Todd's exactly right. This is the time of year where this becomes a really hot topic. Our FBFM staff across the state of Illinois are visiting with farm clients on a daily basis now to talk about year-end planning. And one of the first questions that comes up is this: what should their adjusted gross income be for the year 2023? And to help them analyze that, we think about three things that are not deductible. Those dollars spent for a living and your income taxes and any principal payments that exceed your depreciation deduction, the topic of today's study. In my example on the screen, that comes to $130,000 for these non-deductible expenses. So that's one guideline to help us to define where we should land. Now, you might decide that your AGI wants to be lower than that because you want to reduce your tax liability further, and that's okay. We just need to recognize that when that occurs, we are generating income tax deferral, meaning there might be more tax that needs to be paid sometime later. But again, if that's the plan, that's a good plan. Just want to recognize when those things are occurring. I present this slide that shows our 23 tax brackets. There are 7 different income tax brackets in play for all types of filers. These numbers happen to be the break levels for those who file jointly as a married couple. The tax rates are the same for all filers on the left. It just changes for their income levels depending on your filing status as married filing separate, whether you're single or head of household. You'll have different numbers in this middle column. We also note to the right side these effective rates that are reduced if you're a farmer and you have Schedule F income and 4797 income. Those are certainly 2 types of income that qualify for this qualified business income deduction. And the net result of that really means that your 22% marginal tax rate, for example, turns into an effective marginal tax rate of 17.6%. The key note here is you can have income up to about $364,000 and have a marginal tax rate, if QBIT applies, of not more than 19.2%. These are the lowest rates that I've seen in my 40-year career of preparing tax returns. And they're also the highest bracket levels that we've exhibited for these lower rates as well. Even though Brad's on jury duty, he did bring us some good data about machinery values of how they've doubled in this last 7-year period. If we look at 2021 and jump back to levels before that, you can see that if I go back to 2003, over that 18-year period, they've nearly tripled in value per acre. We know that 2 things are rising here. The value of the machinery asset itself is growing, and we have expanding farms, and their investment in machinery is growing as well. The machinery purchases are also increasing per acre. You see this study was completed through 2021. Our 22 and 23 results are going to be very similar probably to this result in 21 at $67 an acre. And if I take that back to 2016, that's 5 years ago, Those are up, over 3 times just in that short time frame. But in an 18-year period, you can see they're 4 times as much of an increase per acre. So we know that more purchases are being made, and depreciation becomes a lot more critical element to the tax planning business side of farming. When you make these purchases, there are 3 types of choices available to affect the tax deduction. The first one, and they go in this order, is the 179 election, the expense election. That's a single dollar amount that you choose to deduct for each purchase item for each selected asset. Then we move to the second option, which is bonus. And in prior years, we've had none of this available. We've had 30% available, 50%. We've had 100% available. And you'll see we're going to add to this slide today, there's an 80% bonus deduction available in 2023. This is more lumpy. It's for a group of assets at a time that you're going to elect to deduct 80% or not deduct 80%. So it's much more lumpy or wide choice of deductions compared to the 179, which can be elected really on a every dollar increment. The purchases are used as a cash expense, and this could mean that you are using what we call the de minimis rules, such as small materials and supplies. If you're spending under $2,500, then these could land in the cash expense category. Any amount that's not used under the 179 or bonus is going to be placed into our regular maker's depreciation life, and we'll show you more about that in a moment. One of the key effects on purchases occurred for years ending after December 31 of 17, where trades of machinery really don't mean anything anymore. We have to reflect in our books and records the full purchase price of the asset, and we also have to reflect the trade-in value of the asset we're giving up. And the trade-in value is a taxable sale, even though you really receive no money for it and you don't have a deposit to take to the bank. The trade-in value is treated as a sale, but the full purchase price is available to use as a full deduction. So for 2023, what's new and different? So we mentioned 100% bonus existed through 2022. For 2023, this is the first year where something less than 100% has been available since the beginning of the TCJA, the Tax Cuts Act, in 2018. And this is designed to be a continuing step down provision. So it'll be 60% in 2024, and we'll show you the full step down in a moment. The 179 deduction is the second group of information that we share for 2023. That's a large deduction, the largest deduction ever, I would say. 1.16 million is the maximum deduction that's available. And we have a purchase limit as well, and that's 2.89 million. What that means is if you spend more than 1.16, but less than 2.89, your deduction for 179 purposes is reduced dollar for dollar, such that if you spent over 2.89 million, you begin to lose that 179 deduction maximum of 1.16. All assets qualify, new or used, for the 179 deduction. New and used also qualify for the bonus. One thing that does not qualify is if you're buying assets from a related party. And in this instance, think about lineal descendants. So if I sell a truck to my son, he will not be able to use these accelerated bonus provisions because that's a related party transaction. Oddly enough, a related party for this rule is not my brother or sister. So I sell a truck to my brother, he can use the accelerated depreciation rules shown on this screen. And it's, the first full week of November. We have a little time yet until December 31 arrives, but we have to be aware that the asset must be placed in service to be eligible for a depreciation deduction. And my definition of that is it must be in a state of readiness for its intended use. So if you have a purchase order for a tractor that's going to be built in March, it doesn't meet this definition of a state of readiness. If you have a machine shed that's going to be constructed next March and they bring all the lumber to your site in December, that also does not meet this definition of in a state of readiness for its intended use. So to validate your depreciation deduction, be sure that the property is available to be placed into service. So Brad has this really unique analysis of comparing our 179 deductions. That's the top part of the slide. They say that in 2003, we only had a $100,000 179 limit. And our purchases per acre were $14 an acre. You see how those change as the 179 limit increases. And this again affirms that in 2021, we had $1,050,000 and now we have 1.16. Obviously the highest value in 179 deductions we've ever had. But there is some correlation, I think, as those deduction limits rise, there is some increase purchase dollar per acre. Now for the green sections that's shown on our slide, that was stuck at a 500,000 179 limit for several years. And because of the elongated time period of that limit, the greater impact on machinery purchases was net farm income. Here's the slide that describes our bonus depreciation changes. We, in 2003, had 50%. Then for a few years, we had no bonus available. It came back in 08 and 09 as a part of the real estate, financial recovery rules. Jumped up to 100% for part of the time in 2011 and 12, a full 100%. Then back down to 50% for a while. Back up to 100% during the TCJA startup in 2018. And that's where we're at in 2022. But you see in 23, it's 80%, 24, 60%, 25, 40%, and 26, 20%, and 27, 0. Now, will these change with the next round of elections and potential legislative changes? Well, certainly possible. All we know today is what the schedule going forward looks like, but the schedule could be modified, continued, or phased out. Brad does a similar study about bonus phase outs compared to 179 and how they compared between the 179 election amounts and the bonus provisions. And you can see in 2022, 21, 20, 19, 18, we've had the largest level of both provisions ever on our books. For when I started my career in 1984, that expense election limit was $10,000, a very, very low number. Let's get into one brief example of how this works with an $85,000 trade-in. That tractor was purchased for $90,000 and has been fully depreciated. And we're trading that in to buy a new tractor that costs $185,000. So our net trade-in is $100,000. And for a long, long time, this meant something. But it is irrelevant right now for tax purposes. What we're interested in is the trade-in value, because we first must report that $85,000 gain as farm income on our Form 4797. That gain's not subject to self-employment tax. It is eligible for income averaging. It is eligible for the qualified business income deduction, but it gets reported as a separate item of income on this form. Now, to offset that, we have a $185,000 purchase that was eligible for depreciation that will be deducted first on Form 4562, but ultimately on our Schedule F. And this $185,000 amount could be fully expensed under 179 if otherwise eligible. 80% of it could be deducted through bonus, or we could elect to take a regular depreciation deduction which would be about a 14% deduction if that option was chosen. This is a big change that was just announced within the past a few days. IRS Pub 225 is called the Farmer's Tax Guide, and here lots of rules are identified and processes and methods prescribed for preparing farm tax returns. And one of the key issues that we were challenged by was before 2023, this machinery sale I just described, $85,000 on Form 4797, was not deemed to be gross income from farming. And that caused those gains from trade-ins to disqualify a taxpayer who really was a farmer, but if they had lots of 4797 gains and a limited amount of Schedule F gross receipts, they might no longer be eligible to be a farmer and enjoy the ability to make only one estimated tax payment a year. We worked pretty hard on getting this adjusted, and we're glad to report that the new Pub 225 document prescribes sales of farm machinery as in fact being gross income from farming. And the challenge that's highlighted in the second bullet point on the screen will no longer be applicable for our 2023 tax returns. This is really good news for our farm clients who don't have to fret anymore about trade-in values creating an undesired failure to qualify as a taxpayer farmer. Really good news here that's just been announced. So these farm clients that are self-employed Schedule F filers also deal with self-employment tax. And one of the key points that we describe in our third bullet point to lower this tax is these trades can really work out as an advantageous reporting item. As the trade is reported on the 4797, that amount is not subject to self-employment tax. While the full purchase price is appreciated on the Schedule F, that does reduce self-employment tax. So getting these trades reported properly, while extra steps included, I agree, can have a very beneficial result for our Schedule F sole proprietor self-employed farmers. I want to visit just briefly about stepped up basis. These occur when a farmer passes away and he owns certain farm assets at the time of his death. And I will list grain inventory, prepaid expenses. If I want to focus about machinery value primarily, all of these items I'm showing on the screen get to be deducted again by the successor. They get a new basis stepped up to the fair market value of the asset at the time of the farmer decedent's death. And if we focus on the machinery value, that $600,000 number will be deemed to be used property, deducted under a 7-year method for the successor. That might be the spouse, it might be a trust, it might be another farming heir, but whoever acquires that asset needs to know to revisit a depreciation schedule because there are new deductions coming available. That is also true with the last two on this screen. A machine shed is listed, that's a 20-year property. Grain bins, 7-year, tile is 15-year. Fertility, I generally lumped as a 4-year item. These are all deductions that accrue to the successor owner of these assets that a farm operator had owned. And I'll add to that, a materially participating farm operator had owned. We had a question about depreciating fertility, and I'll touch on that briefly. Yes, that's an asset that I've placed on farm depreciation schedules for many years. We obtain some valuation of the fertility that is in that farmland that has been either inherited or purchased. We compare that to some baseline of fertility value, and that excess amount is placed on the depreciation schedule and depreciated over, I've often used a range of 3 or 4 years. It depends on the type of product that's being depreciated and how quickly it is consumed. But that can be a very good additional deduction generated from this stepped up basis provision or through a purchase asset. Favorable capital gains accrue. We often know about land sales. When the sale price exceeds the cost, we have a capital gain, in this example, $14,000 per acre. It's rare, but in 2022, I think was the first time I reported any machinery sale capital gain. For that to be true, the sale price has to be greater than the original cost basis of that asset. And we have to be sure that we get all of the cost of that asset accounted for. It might not just be the last pickup truck cost traded in. There might be rolled pickups or combines or grain carts that we have to look back to be sure that the full cost of those assets is recognized. But in, I would say, atypical conditions, but more regular than in prior years, when the sale price exceeds that cost, there could be a capital gain produced, which accrues to these more favorable tax rates. The caution would be sure you find all of the costs that should be attributed to that asset, because generally there's not much capital gain, but there could be. When you're selling machinery, let's think about the person who's retiring or liquidating their farm activity. They often think about doing that in an installment sale, but that's a tax trap. IRS has identified the full contract price is taxable in that year of sale, at least to the extent of depreciation that's being recaptured, even if the full price isn't paid in that year. So be cautious about sales of machinery. When depreciation has been claimed in prior years, that amount has to be recaptured in the year of sale. It doesn't matter when the payment occurs, so just be extra cautious on handling these sales properly. Now, the buyer is going to get their depreciation, when that sale commences, but we want to be sure that they're not a related buyer, because if they're a related party, they don't get any of the extra bonus or 179 deductions available. They only get these deductions over time if they're a related party. The seller probably has a large income in the year of sale due to that big depreciation recapture. So they may want to consider a long-term lease with some periodic purchases occurring as opposed to an installment sale of machinery. Brad gives us some more really interesting data on the types of machinery that have been purchased by our farm clients. In this study, that covers about a 15-year period, and you see combines represent the one of the larger purchase components of machinery. Tractors are at the top of the list, or nearly always at the top of the list. Then we see a few other things: the planters, combine heads, heavy purpose trucks. That's the mix of these large pieces of investments that our farmers must make. I thought it was really interesting how this is sort of shifted over time, but tractors and combines still lead the pace here. The trucks moved from 11% long ago to only 6%, as that's been made up by larger increases in combine costs primarily. Brad did the same study for farm buildings. You'll see tiling, although not a building, it's in this farm improvement category that we're describing here. Tiling represents a very large piece of a single asset. Grain bins close behind that. Machine sheds come in third, and a variety of other items. Livestock buildings would be included in this group. Shops might be identified separately from machine sheds. Farm garages might be in that group. But a very broad variety, almost 40% fits in this broad other category. But still, the tiling component is almost as much as all other types of assets. I've never seen this kind of study done. Kudos to Brad for gathering this data in such a unique manner of presentation. Brad also studied when these purchases are made, and that's the reason we're doing the seminar today. You can see most of the purchases occur in the fourth quarter for our farm clients. A third of those happened in the fourth quarter in this 19 to 20 time period. 35% of those purchases occurred in the fourth quarter, and some other time periods in that 9 to 13 4-year measuring point. A few more happened in the first of the year. I think that's mostly attributed to, well, we got the deal done in December, but it really didn't arrive or get produced until the first quarter. But clearly the fourth quarter is the time when purchases are made and these decisions are ripe to be made, to be analyzed and executed. We have this slide that talks about deferred tax. I mentioned in my opening slide that if your AGI is below the level of those 3 non-deductible components, you're increasing your deferred tax liability down the road. And Brad's study here points that out vividly. From 2003 to 2021, how much tax we have pushed down the road. And one of the larger groups that's grown is this intermediate category, which is where farm machinery and equipment lies. And because of the large depreciation deductions we've had available, we've deferred the tax liability on those assets substantially down the road. You can see this is an accumulated over $800,000 value, compared to 2 decades ago. It was just about a $200,000 measurement. So some rapid growth in this number until 2012, and even some slight increases in the last couple of years. I have a couple of examples to kind of walk through these as we get to the last few minutes of our presentation. So this first example is very straightforward. We bought a used tractor, no trade-in, $100,000 price. New equipment has a 5-year recovery period. This is a used tractor, so it's going to land in the 7-year recovery period cycle. And we have 3 choices to take this purchase to our depreciation schedule, to Form 4562, and ultimately to Schedule F. The first option, and they go in this order again, is the 179 expensing limit. We could take a $100,000 deduction of this tractor. We could take $1,000, any number in between we could choose to use as our 179 deduction. It lets us precisely point to an AGI level that we prefer. And here's the first time we kind of look at this in a new fashion. Bonus can be used of $80,000 in 2023. In the several prior years, that was 100% deduction. We don't want our farm taxpayers to be surprised by the fact that if they're using bonus, they only get 80. They also get another $2,857 because that's the regular deduction on the other $20,000 that wasn't available for bonus. So if they don't use 179, their maximum deduction would be $82,857. Remember, this is lumpy. They can choose to take an $80,000 deduction, or they take a 0 bonus deduction. There's no number in between to pick and choose from like there is with the 179 deduction. And here's the other surprise to prepare for. If this purchase was done in 2024, there would only be a $60,000 bonus depreciation deduction, not 100. This is declining rapidly. The third choice that exists is regular depreciation. None for 179, none for bonus. They could just choose to take the regular maker's depreciation, and on a $100,000 purchase in the first year, that would be a $14,286 deduction. So with this one simple transaction, you can see that we can lay out for our clients the choice of a $100,000 deduction, or 0 from 179, $82,000 if they choose to use bonus, or $14,000 if they only choose to use a regular depreciation deduction. It's never been this variant on the choices until this year. Let's look at a machine shed. This is one that I know people are constructing right now to meet that available for its intended use definition. So let's think about one that's a $300,000 value. This is a 20-year recovery period. Oh, we do have a question on the 179. Could they take the 20,000 that was left over from the bonus? Well, it actually works in reverse of that. You make your 179 election first. So if they had elected to take a 20,000 179 deduction, then they could have used bonus on the other 80. So the ordering is critical. So they could take 179 first, and then they're left with bonus as they choose going forward. I presented an example in that way with the, I guess, premise that they didn't want to take any 179, or maybe they weren't eligible to take 179. Not everybody is. Maybe they are a cash rent landlord. They're not eligible to take 179. Maybe they're a passive investor. Maybe they have a overall business loss. There's other reasons they might not be 179 eligible. 179, I'm sorry, for the machine shed depreciation example, this is a property that's not eligible for 179 expensing. It is designed to only include property that has a 15-year recovery period or less. So here, 179 is not an option. We then move to the bonus deduction. Again, the most we could get is 80%, 240,000, plus another 2,250 on the other 60,000 for our regular 20-year recovery period. Reminder that in 2024, if this shed doesn't get done in December, they'll be limited to a $180,000 60% bonus deduction if it doesn't get done till January or February. Now, they don't lose the other deductions, correct? But they have to take those other deductions, the other 60,000 or other 120,000 over that 20-year recovery period. They don't lose it. It's just available on a very slow method. If they chose not to use bonus, they could take a regular deduction of $11,250. And here's a point I wanted to introduce that is really messy for our taxpayers in Illinois. Illinois does not allow any bonus depreciation to be claimed. So for their Illinois deduction, their only choice is a deduction of $11,250. So they might be expecting a $300,000 deduction, because that's the way it's been for several years. The real answer is for federal, the maximum they can deduct is $242,250. And for Illinois, their only deduction is $11,250. Their Illinois income will be $289,000 higher than their federal income, than what they think their federal income might be. So don't let our taxpayers be surprised by this development. Only 80% for bonus, only 60% if the shed doesn't get done till January. And for Illinois, it's only an $11,000 deduction. They're going to have an extra $290,000 of Illinois income than they might expect, and that's an extra about $15,000 of Illinois tax that they didn't expect. All right, here's a more complicated, larger dollar one that has extremely surprising results. So let's think about a $3.1 million purchase of machinery. And we know that many of our larger farm clients will get to this point when they're doing relatively frequent trades of large ticket items. In my example, I'm assuming they are trading in $1.8 million of machinery. So their net trade is 1.3, but that doesn't matter except for the amount of check or borrowed funds that we're using. They also have already, prior in the year, produced $1 million cost of a grain system that was constructed, placed into service. We can use that. So they're expecting, under the old rules, an anticipated deduction of $2.3 million. The net trade of 1.3, the grain bin cost of 1 million. So they're expecting a deduction of $2.3 million. Well, here's the headline. That's not what's going to happen. They're going to be unpleasantly surprised by the math that comes up here next. Remember, their total purchases are 4.1 million. Total machinery and the cost of grain, under the old rules, they would have had a $2.3 million deduction. Not what happens here. They don't get any 179 deduction because their total purchases exceeded 4.05 million. Just a little bit, right? 3.1 plus a million. But the total purchases are what we measure, not the trade-in value plus the cash cost of the grain system. So 179 deduction, they get none. Their bonus deduction, well, yeah, they get the full 80%. This is another good example when bonus might have a pretty big value, but it's not a $4.1 million deduction that would have been a year ago. It's 3.28, only 80% of the amount. And yes, they get another 152,000 from the regular deduction on the other 20% that wasn't eligible for bonus, which gives them a total deduction of $3.4 million. Well, that's good, but they really wanted a deduction of 4.1 million. That's the total purchase price. Remember, they also have to report the gain on the trade-in of 1.8 million. So they get their deductions of 3.4, not the full amount that they thought, but they have to report this gain. So the net decrease to their federal taxable income is 1,632,000. And remember, their anticipated decrease when we started was 2.3 million under the long-standing rules that we had where trade-ins mattered and the cost of the grain system mattered. They would have had a $1.3 million deduction, but they don't. They only have 1.6 million because of two reasons. 179 is not available because they had purchases exceeding the limit, and only 80% bonus, not a 20% bonus, not a 100% bonus. So what does that mean for this client? Well, they are anticipating deductions of 2.3 million. They only have deductions of 1.6 million. So their AGI will be adjusted upward by 667,000 more than they intended. And if we jump back to our tax brackets from before, even if they're in that 20% QBID federal tax rate, that's 130,000 additional tax. They're probably in the mid 30s of a tax rate, and that's going to approach $200,000 of additional tax. So this is a really big factor when our clients are making large capital expenditures over that, and all rounded to over that $4 million mark. We need to pay attention to this math and see what really happens. And it gets worse in 2024, doesn't it? Because we only have a 60% bonus deduction in 2024, their reduced deductions are 1.3 million. Not the 2.3 million deduction they'd like. They're only going to end up with a net deduction of about $1 million from those transactions due to no 179 and only a 60% bonus. And here's the real problem. For 2023, yeah, we can't do anything about this. This is the answer for 2023. In this case where they spent $4 million on capital purchases and expected a $2.3 million decrease to taxable income, for Illinois taxable income, they actually have $1 million increase to taxable income. $1.8 million of gain from the trade-ins minus only the regular depreciation deductions from their capital purchases. Because they receive 179 deduction because they're over the 4 million limit, and they get zero bonus deduction because that's the rule in Illinois, they will actually have spent a net of 2.3 million and increase their taxable income by over $1 million. And we know in Illinois that's at a 4.95% rate. So that's an extra $50,000 of income tax that they will incur when they file their 23 return, if my example played out in their situation. One other surprise we want to do our best to help our clients avoid from these new and never before seen rules in 23 compared to some prior years that we've had. So doesn't make sense, does it, right, Jim? I'm going to spend a bunch of money and raise my taxable income, but that can be the outcome in situations like this. Our farm staff, our FBFM staff members are working across Illinois today on these types of depreciation, planning issues, and others. We have 70 staff working across our state to help over 12,000 farm families to understand and get this right and increase the education reach of these tax rules towards our farm tax-paying families. It's been great to spend this time with you today to talk about new changes for depreciation rules. So Jim, I extend my appreciation to you and FarmDoc for letting FBFM share this information today.
Hey, thank you so much, Bob. Todd Gleason here, of course, your host for the day. If you've got other questions, Bob will take them. Jim will make sure that he gets a chance to see them, as I can't at the moment. However, we would like to also take a moment to thank our sponsors. They include the TIA Center for Farmland Research, Compeer Financial, Corteva Agri-Science, Farm Credit Illinois, the Illinois Soybean Association, FS Growmark, and the Illinois Corn Growers Association, and our educational partners who include the College of Agricultural, Consumer, and Environmental Sciences, the Department of Agricultural and Consumer Economics, University of Illinois Extension, and of course, Bob's own FBFM. We do thank you for joining us. If you've got questions, go ahead and get those submitted. Otherwise, we'll wrap up, but make sure that you do visit our website at farmdocdaily.illinois.edu. You can sign up for webinars there in the future. You can also see this one. It'll be in the archive section at farmdocdaily.illinois.edu, or you can just check it out on our YouTube channel at youtube.com/@FarmDoc. Bob, are there any other questions we missed?
We don't think there's any up here. We have a comment that is a complicated subject, and I would just add to that, it definitely is, Ruth. And we're dealing with rules in 23 that we've not dealt with before, and we've not dealt with the synergy of 3 different rules in play, coupled with the Illinois adjustment to not allowing bonus. So the 23 returns will have some interplay of things that we've not dealt with before. We do have one question, Todd. How will retirement sales be taxed with machinery? Retirement sales of machinery are going to be taxed on the Form 4797. They will not be subject to self-employment tax. They should not be subject to the 3.8% net investment income tax if the person selling machinery had been engaged in a farming trade or business. But be cautious about the installment sale piece. The depreciation recapture, IRS requires that to be fully recorded as income in the year of sale. Year of payment doesn't matter. Have you seen 179 deductions taken on, or 180 deductions taken on rangeland? This is the excess fertility deduction. I have never done that. We have in our University of Illinois tax school workbook this year that is actually being taught across the town at the iHotel today by more friends of ACES in the tax school division. And they have an example in that book about rangeland, but it's very difficult to identify, number one, the baseline level of rangeland fertility and also the additional value provided at a change. So I think rangeland is not something that I have personal experience with, but our friends at U of I Tax School have that included in their analysis today. It will also be on the tax school has an ag webinar late in November where it will be covered. Do Illinois CPAs know the changes? Well, I think so. The Illinois bonus change actually happened a year ago, but the federal change from 100% to 80% didn't happen until 23. So we don't have, this is the first year we have all three nuances in play. This has been, I know the Illinois change is highly publicized along the route for changes in depreciation. Professional certifications to look for. Many of our FBFM staff have the IRS designation of enrolled agent. That means they have a certain level of experience, a certain level of knowledge, that they complete a significant amount of ongoing professional development each year. So that is one type of professional designation. Certainly, certified public accountants are another solid designation recognized by IRS to allow those persons to represent the taxpayers before the IRS. So those two are certainly near the top of the list as far as designations. Attorneys have other similar designations where they can represent taxpayers before the IRS.
Given that, Bob, thank you very much. We appreciate you taking the time with us to be here to talk about depreciation rules and taxpayer guidelines for the farm for this tax year. Of course, you can always see this again if you'd like on our website at farmdocdaily.illinois.edu. Look in the archives section or go to youtube.com/@FarmDoc. You've been listening to a Farm Doc Daily our Farm Doc Daily webinar. One other note: if you want, you can always visit Bob's FBFM. It's actually the Illinois FBFM. The address there is FBFM, which stands for Farm Business Farm Management.org. That's FBFM.org. Or you can email them at info@FBFM.org. On behalf of Bob Ray, the CEO of the Illinois Farm Business Farm Management Association, along with our behind-the-scenes technical director, Jim Baltz, I wish you a good afternoon. I'm Todd Gleason.